Okay, so good evening, class. We'll be discussing tonight the multiple choice problems for Chapter 8 of Volume 2 of our textbook, the chapter on notes payable. So basically, your notes payable will be just the mirror or the other side of the equivalent of your notes receivable. It's a notes receivable of one party, and at the same time, it's a notes payable of another party. Okay, so if we are accounting for notes payable, that means we are the one issuing a promissory note. We are the one promising to make a payment, and our obligation is evidenced by a promissory note. Okay, so uh, the main feature or the common areas of inquiry for notes payable problems would be mostly number one, uh, what will be the initial carrying amount of the notes payable? At what amount will the notes payable be initially recognized in our books? And then second would be the amount of interest expense. It's common for your notes payable to include a provision for the stipulation of interest. So second common question here would be how much would be the interest expense related to the uh, related to the promissory note. And the computation of interest expense can become tricky for most students, especially if the promissory note is issued uh, somewhere in the middle of the year, not at the beginning, not at the end, because if that is the scenario, then we will have to use fraction to determine the amount of interest expense, and problems will become even trickier, especially if the promissory note is payable in installment, because by then, if the notes payable is payable in installment, that means the principal component, the principal liability, will also gradually decrease as a result of the principal payment that you will be making periodically. Unlike if the principal is to be paid at the end of the term of the promissory note, then the only transaction that we will have to account for would be for the accrual of the interest. Okay, we will only have to account for the recognition of the interest expense. But if the promissory note is payable in installments, then we will have to deal with the fact that payments during the year will be attributable to both principal and interest. And the third common question here would be the subsequent carrying amount of your uh, notes payable. The balance of your notes payable will not remain constant. So the balance from the in most cases, the balance for subsequent periods will not be the same as the initial carrying amount. And that is why problems will be asking for your subsequent measurement of your notes payable. Okay, so basically the problems will revolve around those questions. Okay. Let's deal with problem 8-10 first. Here, Joshua Company bought a new machine and agreed to pay in equal installment of 600,000 at the end of each of the next 5 years. The prevailing interest rate for this type of transaction is 12%. Okay, the present value of an ordinary annuity of 1 at 12% for 5 periods is 3.6. The future amount of an ordinary annuity of 1 at 12% for 5 periods is 6.35. The present value of 1 at 12% for 5 periods is 0.567. Okay, so to answer this problem, class, we have to settle a theory first. Okay, you will have to answer one question first, and that is how uh, how are your notes payable initially measured? Okay, there are two possible classifications for your notes payable, class, as far as accounting treatment is concerned. They are either going to be measured at amortized cost or at fair value. Okay, but in both cases, your notes payable will be initially measured at fair value. The distinction, the main difference would be on the treatment of your transaction cost. Okay, if you use the fair value option, then your transaction cost will be expensed outright. Okay, that would be a very important theory. But if you use the amortized cost, then you will have to take into account the transaction cost in determining the initial carrying amount of your notes payable. Okay. Uh, and again, as mentioned, regardless of whether or not they are to be measured at amortized cost at or using the fair value option, both are to be measured at fair value. Okay. And the next question you will have to ask would be, how then do you determine the fair value? If the problem does not give you the fair value class, then the fair value would simply be the present value of all the cash flows that you would expect to receive from that instrument. The instrument we are referring to in this topic would be the notes payable or the promissory note. From the promissory note, what cash flows are we expecting to receive? Okay, and once you have identified your expected cash flows, then all you would have to do is to get the the present value of those cash flows, and sum you add them all up, and that would be your present value, which would now represent the fair value of the instrument. Okay, and normally your expected cash flows class will come in two forms. It will come in the form of interest and uh, the principal repayment. Okay, so there are some promissory notes that will provide for a payment of periodic interest. Okay, and of course, all promissory notes have must be repaid. The principal of all promissory notes must be repaid. Okay, so two major sources of cash flows class: your interest and your principal repayment. Okay, but there are some problems, just like this one, wherein we are not expecting interest as part of our cash flows. Okay, in this problem, the cash flows that we are expecting would only be from the installment payments of 600,000 that we expect to receive for 5 years. Okay, so in other problems, uh, it's possible that your cash flows in the form of uh, would come in the form of interest, and at the end of the term, you will be receiving the uh, principal repayment plus the interest on the last period. Okay, but in some other problems, just like this one, our cash flows may in the form of a periodic amount, which will represent both the interest and the principal already. Okay. Um, in accounting, there is an assumption that transactions always have a cost associated with it. So that's why we do not believe in the concept that there is no interest uh, embedded in each transaction. So even if the problem does not explicitly state that there will be interest, there will be a presumption that the transaction will bear interest. Okay, but in this case, the problem is clear that the cash flows that we are expecting would be the installment payment of 600,000 for the next 5 years. So we have already identified our expected cash flows. That is, we are expecting five uh, 600,000s. We expect to receive five 600,000s and 600,000, and we expect to receive these 600,000s on each of the end of the next 5 years. Okay, so uh, you can solve for the present value of the 600,000 that we will receive in 1 year, solve for the present value of the second 600,000, which we'll receive after 2 years, solve for the present value of the uh, third 600,000, which we'll receive after 3 years, solve for the present value of the fourth 600,000, which we'll receive after 4 years, and then solve for the present value of the fifth 600,000, which we'll receive after 5 years. And when you add all the present value of the five 600,000s class, if you add all of them together, you will now get the present value. Okay, and that is you individually get the uh, if you individually get the present values. But there is a faster way, especially if the installments are equal. especially if the installment payments are uniform year in and year out. So instead of doing it for each cash flow, you will be using the annuity factor class. Okay, so the first theory that you were supposed to know from this problem is how are we supposed to measure the notes payable, and the answer was they are to be measured at fair value. And how do you get the fair value? By getting the present value of the expected cash flows. The second thing you're supposed to learn here is in the determination of the present value, in the determination of the fair value, you're expected to know when and how to use the different factors. Okay, we're given with three different uh, present value and future value factors. Okay, so we have here the 3.60, which represents the annuity factor. You have the 6.35, which represents the future value annuity factor also. And then you have the 0.567, which represents the lump sum present value factor. So the challenge now is which of these three can help us arrive at getting the present value of the 600,000 that we expect to receive from this promissory note. Okay, let's start with the 0.567 class. You get this 0.567 in order for you to get the present value of one cash flow that is expected to be received 5 years from now. Okay. So if you only have one cash flow and that cash flow is expected to be received 5 years from now, then you will be using 0.567. If you multiply that with your expected cash flow after 5 years, then you will get the present value of that cash flow. Okay, so that is not what we are going to be using because our cash flows are 600,000 expected to be received in each of the at the end of each of the next 5 years. Okay, so the 0.567 is not the relevant factor here because your 0.567 is only uh, relevant if we only have one cash flow that is expected to be received after 5 years. Okay, then next would be your 6.35. Are we going to be using the 6.35? The answer is no, because the 6.35 is your future value factor. This would give you the value of 5 cash flows. Okay, the 6.35 is the factor that will give you the future value of 5 cash flows after 5 years. Okay, so the scenario wherein the 6.35 is relevant class is that when you are looking for the future value of a periodic cash flow that you will be receiving every year for 5 years. If you are looking for the value of a series of cash flows after 5 years, then you will be using 6.35. Okay, so uh, the idea there is already correct in the sense that we are dealing with more than one cash flow. We are dealing with 5 periodic cash flows. But 6.35 is wrong because it's not getting us the present value of the 5 cash flows. It is not giving us the value of the 5 cash flows as of today. The 6.35 will give you the value of the expected 5 cash flows at the end of the fifth year. Okay, so if your 5 cash flows will earn interest of 12%, how much will you be getting at the end of the fifth year? Then your 6.35 can help you get that amount. Okay, but we are not, the present value is of course not the value that is expected on the fifth year. The present value is the value expected as of today. Okay, so if you have 5 cash flows that you're expecting at the end of each of the next 5 years, how much then is the present value? It is your present value annuity factor that will be relevant. So we'll be using the 3.6. And if you multiply this with your periodic cash flow, then that will give you your present value, which would represent the fair value of your uh, instrument. Okay, so I hope you are familiar. Okay, I'm sure you already have your investment mathematics. So I'm just trying to make sure that you know when and how to use these different present value and future value factors. Okay, the 6.35 is wrong because even though it is for a 5 periodic cash flow, it will give you the future value. Okay, well, the 0.567 is also incorrect, because even though it gives you the present value, it only gives you the present value of a cash flow, of a single cash flow that is expected to be received after 5 years. Okay, the relevant factor here is the 3.6. So you multiply your 3.6 class uh, with your periodic cash flow. So our periodic cash flow is 600,000. You multiply that with our present value ordinary annuity factor, you would get your 2,160,000. And that is our answer in question number 1 here. Okay. Next, for number 2, uh, what amount should be reported as interest expense for the first year? So if you're using the amortized cost method class, your effective interest is to be determined, your interest expense is to be determined using the effective interest method. Okay. And under the effective interest method, you will just have to multiply the carrying amount, or the initial carrying amount of the notes payable, which will be the present value, with the effective interest rate. Okay, for the first year, your interest expense will simply be your initial carrying amount multiplied with the effective interest rate. Okay, and the problem states that the effective interest rate is something is in my the effective interest rate is 12%, so you will just have to multiply the 12% with 2,160,000. So if we do that, to 2,160,000 times the effective interest rate of 12%, we would get you will get 259,200. Okay, so that would be the answer for the second question for problem 8-10. Let's proceed to problem 8-11. Man Company reported a 10% note payable of 3,600,000 on June 30, 2022. The note is dated October 1, 2020 and payable in 3 equal annual payments of 1,200,000 plus interest. Okay, so your periodic payments here, class, will not just be 1,200,000. Your periodic payment would be 1,200,000 plus whatever interest has accrued for the outstanding balance. Okay, the first interest and principal payment was made on October 1, 2020. On June 30, 2022, what amount should be reported as accrued interest payable for this note? Okay, so interest class accrues through passage of time. Okay, so since uh, accrued interest also would be among the commonly asked questions for this topic, especially for problems wherein the issue date of the notes payable do not fall on the start of the year or the end of the year, okay, or the reporting period or the reporting date. Sorry. Okay, so the note is dated October 1, 2020, and payable in 3 equal annual installments. So this means uh, that the first installment payment will happen on October 1, 2021. Okay, so from October 1, 2020, and up to October 1, 2021, the promissory note will earn 1 year worth of interest. Okay, and if it started at 3,600,000, if it started at 3,600,000 and it was able to earn 1 year worth of interest of 10%, so if you multiply 10% with 3,600,000, you would get 360,000. So from October 1, 2020 until October 1, 2021, the amount of interest that will accrue, that would have been earned, okay, by the holder of the promissory note would be 360,000. Okay, but the problem is the reporting date here is June 30. Okay, we will highlight that later on. Okay, but just to emphasize, on October 1, 2021, it says here the first interest and principal payment was made on October 1, 2021. So if in our exam you will be asked how much was the payment, how much was paid on October 1, 2021, your answer should not be 1,200,000. So even though the problem tells us that the annual payment is 1,200,000, but since you're asked for your total payments on this date, you should also compute for the amount of interest. Okay, so you determine how much interest was earned. Okay, as we have determined earlier, the amount of interest earned from October 1, 2020 to October 1, 2021 was 360,000. So that means the total payment on October 1, 2021 is 1,560,000. That is 1,200,000 plus 360. Okay. Now for subsequent years, class, if you'll be asked how much is your total payment for the subsequent year, it will not be the same. It will not be 1,560,000 also. Okay. So even though you will be paying 1,200,000 each year, and you'll be making additional payment for interest, your interest for the second year and the third year will not be the same as the first year, because by the second year, class, the amount of principal that will be earning interest will not be the same as the amount that earned interest in year one. How much was the principal for the first year? It was 3,600,000. That's why it earned interest of 360. But after paying 1,200,000, the remaining principal will just be 2,400,000. Okay. So the amount of interest now that you can earn from October 1, 2021 to October 1, 2022 would just be based on the 2,400,000. Okay, so if you multiply 2,400,000 with 10%, the amount of interest that will be earned from October 1, 2021 to October 1, 2022 will only be 240,000. Then the same thing will happen for the third year. It will go down further because by October 1, 2022, you will also be making another principal payment of 1,200,000, thereby making the remaining principal balance only 1,200,000. So it will only be the third or the final 1,200,000 that will earn interest for the third year. Okay, but that's outside the scope of the question already. We're only asked for June 30, 2022. Okay, so since there was payment on October 1, 2021, whatever interest that has accrued from October 1, 2020 to October 1, 2021, class, it has already been paid. Okay, whatever interest has accrued, it was already paid on October 1, 2021. Okay, so the amount of interest then that has accrued that remains payable as of June 30 would be the interest that is earned from October 1, 2021 up to June 30, 2022. I've discussed earlier that the amount of interest that will be earned from October 1, 2021 to October 1, 2022 will be 240,000. But that is not our answer because we are asking for the amount of accrued interest as not on October 1, 2022, but as of June 30, 2022. So the interest that is accrued on June 30 would be the interest that was earned from October 1, 2021 to June 30, 2022. Okay, and it is considered still an accrued interest payable because payments will only happen every October. So by June 30, the interest earned from October 1, 2021 to June 30, 2022 would remain unpaid. So basically, we will just be computing for the interest that was earned from October 1, 2021 to June 30. Okay, and we can use as basis the 240,000 we have computed earlier. Okay, if the interest from October 1, 2021 to October 1, 2022 is 240,000, but we are only looking for the interest that was earned from October 1, 2021 to June 30, 2022. So you will just have to multiply it with the correct fraction. You just get the correct proportion. If the 240,000 is the interest for 12 months, you compute how many months you are looking for. So that's October 1, 2021 to June 30, 2022. So October, November, December, and then plus 6 months in 2022. We're looking for 9 months worth of interest. So if the 240,000 is worth 12 months of interest, and we're only looking for 9 months of interest, then multiply 240,000 with uh, 9 over 12. Okay, 240,000 times 9 over 12. And you would get 180,000. And that is our answer for this problem. Okay, you can see letter A there, class. It's 270,000. You would be answering 270,000 if you still use 360,000 as your basis. Okay, so 360,000 times 9 over 12 will give you 270. But again, if we are on June 30, 2022, the remaining principal here that will be earning interest will only be 2,400,000 and no more, and no longer 3,600,000. Okay. But if you're asked if the question was how much was the accrued interest payable on June 30, 2021, then your answer would have been 270,000, because at that point, it is the 3,600,000 that will be earning interest. So from October 1, 2020 to June 30, 2021, your accrued interest would have been 270. Okay. Then your answer would have been 90,000, class, if the question was June 30, 2023. Okay. So perhaps that is what's going to happen in our exam. You'll be asked for accrued interest payable for different dates. Okay. So at least be prepared. 8-12, on December 31, 2022, BART Company purchased a machine from File Company in exchange for a non-interest bearing note payable requiring 8 payments of 200,000. And then at the date of issue, the first payment was made on December 31, 2022, and the others are due annually on December 31. At date of issuance, the prevailing rate of interest for this type of note was 11%. On December 31, 2022, what is the carrying amount of the note payable? December 31, 2022 is also the date of the issuance, so we're basically asked for the initial carrying amount. As what I've told you, this is perhaps the most commonly asked question for this topic. So we have our cash flows, class. We will not have periodic interest because the note does not provide a provision for interest. Our cash flows will come in the form of 8 payments of 200,000. We will have a series of cash flows. We'll have periodic cash flows of 200,000 for the uh, for 8 periods. Okay, and we are given with 2 factors here, class, both for present value, both for annuity, class. Okay, but one is ordinary annuity, and then another is for annuity in advance. So basically, what is being asked here is whether or not we know how to we know which of these 2 factors should be used. Okay, you use the ordinary annuity, class, if the first cash flow is expected 1 period from now. Okay, but you use the annuity in advance if the expected cash flow is expected on the date of the issuance, class. So meaning there is an expected cash flow on the same date that the promissory note was issued. We're expected to make a payment on the same date that we are issuing the promissory note. Okay, and that is exactly the case here. We issued the promissory note on December 31, 2022, but also on the same date, we will be making a 200,000 payment already. Okay, so in reality, we were not able to get a loan for 200,000 because on the very first day, we will already have to pay 200,000. So in this case, we will be using the annuity advance factor. Okay, so 5.712 multiplied by 200,000, and we will have 1,100,000 1,142,400. That would be the present value of our uh, our 8 200,000 class. Okay, but since the question here is what is the carrying amount, okay, since there is already a payment also class, please do not forget to deduct 200,000. Okay, please do not forget to deduct 200,000, the amount of payment. So the correct answer here would be 942,400, and this is where students would be normally tricked class. Okay, they would be able to get the answer. They would be able to get that they will be using the 5.712. Okay, because that would be your reference point. That is where you will be starting. You will be using 5.712, and then uh, multiply it with 200,000. And the 1,142,400 that you would get, class, is the present value of the 8 200,000 before the first payment. But since the first payment will be done on the same day, your carrying amount then by the end of the day would be reduced by 200,000. Now, if you have studied the textbook, class, normally your payments will be allocated. Your periodic payments will be allocated between the principal and the interest. But for advance for notes payable that require a payment in advance, class, the first payment will be applied entirely and directly to the principal, because as of that point no interest has accrued. As I have mentioned earlier, interest is earned through passage of time. Okay, but if your first payment happens on the same date of the issuance of the promissory note, then the entire payment will be applied to the principal. So there will be no amortization here. There will be no splitting of the principal component and the interest component. The 200,000 here will be reflected as a payment, will be reflected entirely as a payment of the principal. So even though the present value of 8 200,000 in advance would be 1,142,400, its balance of at the end of the day will only be 942,400. Okay, so please be careful for problems that will have to use annuity advanced factors. Okay, if you're asked for the carrying amount, please don't forget to deduct the first payment. Okay, if the question was how much was the carrying amount immediately before the first payment, then your answer would be 1,142,400. But if you're asked what is the carrying amount for that day, please do not forget to deduct in full the first installment payment. At the beginning of the current next problem, at the beginning of the current year, Paros Company borrowed 3,600,000 from a major customer, evidenced by a non-interest bearing note payable due in 3 years. The entity agreed to supply the customer's inventory needs for the loan uh, period at an amount lower than market price. At the 12% imputed interest rate for this type of loan, the present value of the note is 2,550,000 at the date of issuance. Uh, what amount of interest expense should be reported for the uh, current year? Okay. Uh, the present value is 2,550,000 class. So we will start with the 2,550,000. And then you multiply the present value, which would be your initial carrying amount, which serves as the fair value. You multiply it with the effective interest rate of 12%. Then you would get your 306,000. And that's it. That will be our answer. Okay. The possible point of confusion here would simply be whether or not you know that you are supposed to use the 2,550,000. Again, the rule is initially measured at fair value, and the fair value is simply the present value. And in this case, you're already given with the fair value of 2,550,000. If you're asked how much is the initial carrying amount, our answer would be 2,550,000. And under the effective interest method, interest expense is simply your uh, present value times the interest rate. Okay. The 3,600,000 class would serve as the maturity value. That is the amount that you will have to pay at the end of the 3 years. So basically, the 2,550,000 is the lump sum present value of your 3,600,000. Okay. And your interest expense here would be simply 2,550,000 times 12%. 8-14. At year-end, Roth Company issued a 1 million face amount note payable in exchange for services rendered. Uh, the note payable made at usual trade terms is due in 9 months and bears interest payable at maturity. The market interest rate is 8%. The compound interest factor is 1. Due in 9 months at 8% is 9.44. At what amount should the note payable be reported at year end? So this can be considered as a trick question for those who will not study well, class. Uh, Discounting to get the present value class will be done only if uh, the if the term of the promissory note exceeds 1 year, class. If it's less than 1 year, then the face value will be treated as its uh, present value, class. Okay, so here no need to discount, no need to multiply 0.944 with 1 million. The the note payable will simply be reported at 1 million. Okay, no discounting will happen here. Okay, so your answer here will simply be uh, 1 million. Okay, this will be a trick question. We apply only the discounting, we only apply the solving of the present value for terms that exceed 1 year. Okay. 8-15, on September 1, 2021, Pine Company issued a note payable in the amount of 1,800,000 bearing interest at 12% and payable in 3 equal annual principal payments of 600,000. On this date, the prime rate was 11%. The first interest and principal payment was made on September 1, 2022. On December 31, 2022, what amount should be reported as accrued interest payable? So basically very similar to the one problem we have encountered earlier. Okay, so the total here is 1,800,000 and you will be paying 600,000 every year plus interest. And payments are to be done September 1 of each year beginning 2022, beginning 1 year from the issuance of the uh, promissory note. Okay. Uh, if the question, class, was on December 31, 2021, okay, different from what is being asked here, what would have been our answer? Our answer will be based on the 1,800,000 because from September 1, 2021 to December 31, 2021, the outstanding principal is still 1,800,000. And in that case, it is the entire 1,800,000 that can still earn interest at this point. So you multiply 1,800,000 times uh, 12%. Okay, you would get 216,000, but that 216,000 is worth 12 months. Okay, but I am revising the question. What if it was on December 31, 2021? So definitely the amount of time that has lapsed from September 1, 2021 to December 31, 2022 uh, would be September, October, November, December, 4 months only. So you multiply the 216,000 by 4. Okay, the amount of interest that has lapsed, the amount of months that has lapsed divided by 12 months, and we would get 72,000. Okay, and our answer here is not 72,000 in this problem because this problem asks for December 31, 2022. Our answer would have been 72,000 if the answer would have been, if the question had been for December 31, 2021. Okay, now the question is, why is the 72,000 still considered an accrued interest payable as of December 31, 2021? It's because the payment will only happen September 1 next year. Okay. If you were asked how much was the accrued interest payable in September 1, then your answer would have been zero because at that point, whatever interest that was earned by the creditor that has already accrued, it would have already been paid at that point. Okay. Now, why is the answer for the second year? Why is the accrued interest payable for December 31, 2022 not 72,000 also? It's because, just like what we discussed in the earlier problem, the principal, the remaining principal that will be earning interest from September 1, 2022 to September 1, 2023 will not be 1,800,000. Okay, remember that the 72,000 was based on the 1,800,000 because from September 1, 2021 to September 1, 2022, the principal that will be earning interest is still 1,800,000. From September 1, 2022 to September 1, 2023, the amount of principal that will be earning interest will no longer be 1,800,000. It will just be 1,200,000. Why is it lower this time? Because by September 1, 2022, there will be partial payment on the principal. The original principal was 1,800,000, but on September 1, 2022, payment of 600,000 was made, and additional payment for interest was also made. Okay, so the 600,000 payment on September 1, 2022 will be charged to your 1,800,000 principal. So starting September 1, 2022, the remaining principal would be 1,200,000. And that will be the amount of principal that will be earning interest from September 1, 2022 to September 1, 2023. By September 1, 2023, you will make another principal payment of 600,000. So by then, the remaining balance would just be 600,000. So the amount of principal that will be earning interest from September 1, 2023 to September 1, 2024 will just be the 600,000. Okay, so again, I mentioned from the very start, problems involving installment payments can be tricky. Okay, so please, I hope you're able to get the point here. So our basis for interest now, if we're looking for the December 31 balance, would be 1,200,000 because as of this point, the remaining principal is 1,200,000. If we multiply this with 12%, you would get 144. But the 144 here is good for 1 year. The 144 here is the amount of interest that will be earned from September 1, 2022 to September 1, 2023. But what we are looking for is only for September 1, 2022 to December 31, 2022. And again, that is also still good for 4 months. So you multiply your 144 by 4 over 12, and you would get 48,000. And that will be your answer. Okay, it's not 72, it would be 48,000. Okay, by the way, if you will be asked how much would be the total payment on September 1, 2022, it's 600,000 plus whatever is the interest for the 1,800,000 times 12%, you get 216, you add the 600. So total payment on September 1, 2022 would be 816,000. Okay, please take note. Maybe this will come out in our exam. If you are asked how much is the total payment on September 1, 2023, okay, you will still begin with 600,000, and then you just have to add 1 year's worth of interest. But this time, the 1 year worth of interest will not be 216 because the amount of principal that will be earning interest will only be 1,200,000. So you multiply 1,200,000 by 12%, you add 600,000, and you will get 744. That's the total payment on September 1, 2023. Okay, and I might extend it to September 1, 2024. Okay, so that's 600,000 plus the interest on the last 600,000, which is 600 times 12%, you will get 72. So the total payment on the final year would be 672,000. Okay, I hope you're taking note. Proceeding to the next problem, problem 8-16. On March 1, 2021, Alpha Company borrowed 1 million and signed a 2-year note payable bearing interest, a 2-year note payable bearing interest at 12% per annum, compounded annually. Interest is payable in full at maturity on February 28, 2023. What amount should be reported as accrued interest payable? So basically, we will just have to compute the amount of interest that is earned. And again, remember that interest is earned through passage of time. Okay, but what is unique in this problem is that interest is compounded annually. Okay, so when there's compounding class, basically it just tells us that whatever was earned as interest before will be earning interest in the subsequent periods. Okay, so that will greatly increase the rate of your interest. Okay, on the first year, only the principal will be earning interest. In the second year, the principal will be earning interest again, and the interest earned by the principal in the first year will be earning interest this time. On the third year, the principal will again earn interest, and then the interest earned by the principal in the first year will again earn interest. The interest earned by the principal in the second year will again earn interest. The interest earned by the interest in the first year will now earn interest. Okay, so that would be one, two, three, four. You will now have four sets of interest. On the fourth year, it will be even more. The principal will again earn interest. The interest earned by the principal in the first year will earn interest. The interest earned by the principal in the second year will earn interest. The interest earned by the principal in the third year will earn interest. The interest earned by the principal in the first year during the second year will earn interest in the subsequent year. And I hope you get my point. It's like a uh, pyramid. It would keep on extending and extending because interest will earn interest under compounding. Okay, and luckily, class, we're only asked for the second year. Okay, so at least it's not very complicated. Okay, so for the first year, that's from March 1, 2021 to March 1, 2022. Uh, how much interest will be earned? We have the principal of 1 million, and then it will earn interest of 120. Okay. So on the first year, we have interest of 120. Now the question is on December 31, 2022. So we will have to compute for the interest from March 1, 2022 to December 31, 2022. So that will be good for 10 months, class. Okay. So for this second period, the principal will still earn interest. Okay. But the interest that will be earned here will not be 120 because it's only for 10 months. Okay. We have 1 million times 12% times 10 months divided by 12. You will have 100. The 100 here represents the interest earned by the principal from March 1, 2021 to March 1, 2022 to December 31, 2022. Okay. And then, but the answer here is not 100,000 because we will have to accumulate all the interest that was earned from March 1, 2021 to December 31, 2022. So from March 1, 2021 class to March 1, 2022, we had interest of 120. That will be part of our accrued interest payable because the problem states interest is payable in full only upon maturity. Okay, so whatever was earned, it will remain unpaid. So it will be part of our interest payable. Okay, we had 120,000 for the period of to March 1, 2021 to March 1, 2022. Then we have determined that the interest earned by the principal from March 1, 2022 to December 31, 2022 is 100,000. If you add those two together, you will have 220,000. But that will not be the answer yet because for March 1, 2022 to December 31, 2022, the interest that was earned during the first year, the interest that was earned by the principal from March 1, 2021 to March 1, 2022 would also be earning interest, okay, because of the compounding. How much was the interest earned by the principal in the first year? It was 120. These 120,000 will in turn earn interest. So 120,000 times 12%. Okay, but again, the interest, the first interest, the very first interest will only be earning interest for 10 months lang since we are asked for December 31, 2022. So you multiply the 120 multiplied by 12%, representing the interest earned by the interest. Okay, but since the result of 14,400 here represents 12 months, we reduce this proportionately by multiplying this with 10 over 12. We would get 12,000. Okay, so all in all, by December 31, 2022, all the interest that has accrued are as follows: 120,000, the interest earned by the principal in the first year; another 100,000, the interest earned by the principal on the second year for 10 months; and the third component would be 12,000, the interest earned by the 120,000. Okay, the 10-month interest earned by the 120,000 interest. So you have 12,000 plus 100,000 plus 120,000. Your answer here would be 232,000. Okay. I do not expect this to be asked during the exam. On January 1, 2022, Solemn Company sold land to Glory Company. There was no established market price for the land. Glory Company gave Solemn Company a 2,400,000 non-interest bearing note payable in 3 equal annual installments of 800,000 with the first payment due December 31, 2022. The note had no ready market. The prevailing rate of interest per a note of this type is 10%. The present value of a 2,400,000 note payable in 3 equal annual installments of 800,000. The 10% rate of interest is 1,992,000. So basically, that's our present value. That's our fair value. That will be our initial carrying amount. Okay, but that will not be our answer because the question is not as of January 1. The question is not for the initial carrying amount. It is for the subsequent carrying amount. And this is now the one I mentioned as a third commonly asked question, the subsequent balance of our notes payable. Okay. Uh, you have your 1 million. We begin with your 1,992,000, and then deduct the payment. And what payments will be done here? 800,000 at the end of every year for the next 3 years. Okay. But the 800,000 here will not be charged entirely to the principal. So if your answer here is 1,192,000, then definitely that's wrong. In the 800,000 here will have to be split between the interest and principal payment. Okay, then you would ask, but it is non-interest bearing, sir. It does not matter. Again, we do not subscribe to the idea that there is such thing as non-interest bearing. For us, when we encounter non-interest bearing, we just interpret it as interest being hidden, interest being implied, interest being embedded in the payments. Okay, so you will have to split the 800,000 between the interest component or the interest expense and the amount that will be paid to the principal. Okay, and since you will have to pay, since only the residual will be applied to the principal, you will have to determine your interest expense first. So you multiply 1,992,000 with the effective rate of 10%, you would get 199,200. If you are asked how much is the interest expense for the first year, your answer would be 199,200. Then that means out of the 800,000, 199,200 should be appropriated or should be allocated for interest. So that means the amount that will be considered as a payment for principal will be 600,800, and it is the 600,800 that will be deducted from the 1,992,000. Okay, so 1,992,000 less 600,800, you would get 1,391,200. And that is our answer in this problem. Okay. Going further, class, if you are asked, okay, so this is a possible scenario for our exam. On December 31, 2023, okay, moving on to the next year, what would be the carrying amount of your notes payable? Okay. So you just follow the same. Okay. Do not deduct the entire 800,000 to the principal. Okay, you allocate the 800,000 payment between the interest component and the principal repayment. Okay, but of course, please don't expect that the allocation will be the same in the year one. Okay, in year one it was 199,200 interest and then 600,800 principal. No, it will be different in the subsequent year because your interest expense for 2023 will now be based on your 1,391,200 balance. Okay. So if you are asked how much is the interest expense for 2023, your answer would be 1,391,200 multiplied by 10%. And your answer should be 139,120. Now, if you're asked how much is the balance for the notes payable after uh, year 2, you deduct the 139,120 from the 800,000, you would get 660,880. And the 660,880 would represent the principal payment for the second year. And this is the amount that will be deducted from the carrying amount last year. Okay? The carrying amount last year was 1,391,200. With a payment of 800,000, we will deduct 660,880 because that's the amount that represents the principal payment. And the carrying amount of the notes payable would be 730,320. Okay. If you're asked further for 2024, then it should be zero because at that point it is already fully paid. Okay. I hope you're able to take note of this. Problem 8-18, on January 1, 2022, Easy Company reported a note payable of 1,200,000. The note is dated October 1, 2021, bears interest at 15%, and is payable in 3 equal annual installments of 400,000. The first interest and principal payment was made on October 1, 2022. And the question is what amount should be reported as interest expense for 2022? So this was for January 1, 2022. The note is dated October. And then the first, so this is very similar to the other problems we have solved. What amount should be reported as interest expense for 2022? Okay, so the unique thing about this problem is that during the year, the principal balance changed. Okay, so our computation here should have two components. Okay, the interest earned by the principal at this amount before the first payment, and then the interest expense on the principal after the first payment. So on January 1, 2022, obviously the balance of the notes payable is 1,200,000. And starting on January 1, 2022, it will be 1,200,000 that will be earning interest. Okay. But on October 1, 2021, it will not be 1,200,000 anymore that will be earning interest because there were payments on the principal already. Okay. So what does that mean? The 1,200,000 will only be earning interest from January 1, 2022 to October 1, uh, October 1, 2022. So that is good for 9 months. So the 1,200,000 will be earning interest at 15% for 9 months. Okay, but since the question is for the entirety of 2022, we will now have to determine how much interest was incurred. Was incurred for October to November and December. Okay, so let's start with the 1,200,000 first. The 1,200,000 times 15%, okay, but only for 9 months, times 9 over 12 will give us 135,000. That is the amount of interest. That is our interest expense from January 1, 2022 to October 1, 2022. Why do we not just go directly for the entire year? Because by October 1, 2022, the amount of principal that will be earning interest will no longer be 1,200,000. Why? What happened in October 1, 2022? There was a principal payment of 400,000. So that means starting October 1, 2022, the amount of principal that will be earning 15% interest will only be 800,000. Where did we get 800,000? The initial balance of 1,200,000 minus the principal payment of 400,000. Okay, and the 800,000 will be earning 15%, but for 2022, it will only be earning for the months of October, November, and December, and that is 3 over 12. Okay, so you have 30,000. So from January 1, 2022 to October 1, 2022, our interest expense was 135,000. Then from October 1, 2022 to December 31, 2022, the amount of interest incurred is 30,000. You add those two to get the total interest expense for the 12-month period. Our answer would be 165,000. Okay. So 8-19. So here basically you'll be asked to compare the correct one and the wrong thing done by the entity. Okay. So lube company frequently borrowed from the bank in order to maintain sufficient operating cash. The loans were at a 12% interest with interest payable at maturity. Okay. The entity recorded interest expense when the loans are repaid. Okay. So this is what's wrong here. Supposedly, uh, at the end of each year, you will have to prepare adjusting entries to accrue whatever expenses that may have accrued. Okay. You do not just wait for the time that they will have to be paid. Okay, but what the entity did was it waits for the date of repayment before it will recognize an interest expense. Why is that a problem? Because if there was a period of time that it was able to that interest was incurred last year, but payment will only happen this year, then last year no interest expense will be recognized, and then all interest, including the interest from last year, will be recognized on the year of payment, and that would be wrong. You will have zero in the previous year, then you will have excess for the current year. Okay. Under accrual accounting, you do not wait for actual payment to recognize income and expenses. Okay. So let's go. And what was recorded in 2022 was only 150,000. The question now is, by how much then would be the interest expense in 2022 be understated if we only recognized 150? So we'll have to compare the correct amount of interest that should have been recognized in 2022 with 150,000. Okay. And we can actually substantiate the 150,000 class, how the problem got the 150,000. So first note here would be the one that was issued on December 1, 2021, meaning last year. Okay, because our perspective here is for 2022. Its maturity is only will be on this year. So what happened? Since no payment happened in 2021, no interest expense was recognized last year. And then, since it matures this year, by the end of the year, the amount of interest that is recognized for this promissory note would be for the entirety of the 1 year period, even though the amount of interest that should be recognized as expense this year should only be from January to October 31. Okay, but since we only recognize the interest expense on the date of payment, by October 31, 2022, we have recognized an interest good for 12 months. Okay. So, and how much would that be? You have 500,000 times 12%, which is the rate for all the promissory note. That will give us 60,000. So that means for this promissory note, we have recognized an interest expense in the amount of 60,000. That's good for 12 months. Okay, but technically that's wrong because the amount of interest that should be recognized in this period in relation to this promissory note should only be for 10 months because it was outstanding this year only for 10 months. That's from January to October 31 of the current year. Okay, but what happened? The entire 60 was recognized only this year because nothing was recognized last year. Okay, so what the entity did was it recognized 60,000 this year, but the correct amount that should be recognized as interest expense this year should be only the interest for the 10 months. So you multiply the 60 by 10 months divided by 12, you would get 50. Okay. So if we're saying that the correct amount of interest expense for this promissory note is only 50,000, where should the 10,000 go? The 10,000 should have been recognized in 2021 because that's the amount of interest that has accrued in 2021. So the correct amount of interest for this promissory note for this year should only be 50. But what was done by the entity? It recognized the entire 60. Okay. But the question is, by how much is the interest expense understated? But based on this promissory note, the interest expense would actually be overstated because it recognized 60, but the correct amount is only 50. But when we take into account the other two promissory notes class, you would see that indeed there is an understatement. Okay. Moving on to the second note. It was issued on February 1 this year. Okay. And it also matured this year. So there's nothing wrong here with the policy of the entity to recognize it on the date of repayment because the issuance date and the maturity date fall in the same year. There will be uh, no amount of interest is lost. Everything is recognized correctly in this year. Okay, and then uh, the third one here, before computing class, on the third one here, it was issued on May 1, 2022, and it will mature on January next year. So since it will not be paid this year, the entity did not recognize any interest from this promissory note. But of course, the correct treatment here is that we have incurred interest from May 1 to December 31 of this year. Okay. But as far as what the entity did, it did not recognize any interest on the third note. Okay. But on the second note, it correctly recognized the entire interest class. How much is the interest? 1,500,000 times 12%. Same for all. But this is only good for 6 months, so times 6 over 12. So the amount of interest that was recognized was 90,000. And that is the breakdown of the 150 that was recognized by the entity class. 60 for the first note and 90 for the second note. The 90 is correct, the 60 is overstated. Okay, the correct one should only be 50. And then what the entity did is that it did not recognize any interest on the third note, even though interest was incurred good for 8 months from May to December. Okay, so the correct treatment here is to recognize interest for 8 months. 800,000 times 12% times 8. Sorry. 800,000 times 12% times 8 over 12. So for the third note class, the interest that has accrued is 64,000, but what was recognized was 0. Okay, so if we add all three class, 64,000 for the third note, 90 for the second note, and then 50 for the 50 for the uh, first note, the total interest expense should have been 204,000. Okay, so if the problem asks how much is the correct amount of interest expense for this year, it should be 204,000. But what was recognized was only 150. Okay, so that means the interest expense is understated by 54,000. 8-20. Jason Company offered a contest in which the winner would receive 1 million payable over 20 years. On December 31, 2022, Jason Company purchased an annuity for 418,000. 250 to provide the 950,000 price remaining after the first uh, 50,000 installment, which was paid on January 31, 2023. On December 31, 2022, what amount should be reported as note payable? Note payable contest winner net of current portion. Okay, so you have a liability for 1 million class, and then out of the 1 million, the 50,000 will be payable the next month. Okay, so definitely the 50,000 there uh, would be considered as a current liability, and then uh, the non-current portion will be 950,000. But of course, the 950,000 will be considered non-current because the next payment will happen more than 12 months from the current reporting period. Okay, so basically, you would be the non-current portion will be the 950,000, but it's wrong to report the 950,000 because it is not at its present value. So what we need is the present value of the 950,000, and the present value there is your 418,250, and that is already the answer. But if you're asked for the initial carrying amount of the liability, it should be 468,250. That includes the full 50,000. Okay, because it's too close to its date of payment, it's as if no interest is included there. Similar to an annuity in advance class. Okay, so out of the 1 million, the 50 is current, the 950 is non-current because it's payable more than 12 months from the reporting period. But it's wrong to say that your notes payable will be at 950,000 because the 950,000 is not at present value. Okay, and even though we are not given with a factor class, the present value here would be 418,250 because it serves as the fair value. If you can buy something for 418,250, then that must be the fair value of such item. If you can buy a 950,000 annuity for 418,250, then that must be the fair value of that 950,000 annuity. So the answer here would be 418,250. 8-21 on September 30, 2023, World Company borrowed 1 million on a note 9% note payable. The entity paid the first of 4 quarterly payments of 264,000. When due on December 31, 2023, what amount should be reported as interest expense for 2023? So you multiply 1 million times 9%, you would get uh, 90,000. Okay, but the 1 million did not earn interest for one whole year. It only earned interest from end of September to the end of the year, which is December 31. So we do not include September. We start with October, November, and December. So that's 3 months of the times 3 over 12. For a while. 1 million times 9%, 1 million times 0.09 times 3 over 12, and you would get for a while, 1 million times 0.09 times 3 divided by 12. And you should get 22,500. Okay. Next would be on December 31, 2023, what is the carrying amount of the note payable? So we just have to amortize class. You split your payment of 264,200 between the principal and the interest. We know that the interest is 22,500. You deduct the 22,500 from 264,200, and then you would get the portion that is payable to the principal. You deduct that from the principal of 1 million, you would get 758,300. Okay. It's similar to the amortization problems we have discussed earlier. 8-22, fair value. On January 1, 2022, Justin Company borrowed 2 million on a 10% 5-year interest-bearing note. On December 31, 2022, the fair value of the note is determined to be 1 million, and the entity irrevocably elected a fair value option in measuring the note payable. So important theory lang class, if the fair value option is used to measure your notes payable, then your interest expense will not be based on the initial carrying amount, will not be based on the present value. It will be based on the face amount. Okay, so simply your interest expense here would simply be based on the 2 million. So 2 million times 10%, you will get 200,000. Okay, so it will actually be simpler if it's under the fair value option. Okay, but we do not expect a lot of problems to be asked under this scenario. What is the carrying amount of the note payable on December 31, 2022? And this is what makes the fair value option a lot simpler. You just determine the fair value on that date. No need to amortize. No need to amortize. Whatever is the fair value on that date, that would be the carrying amount. Okay? You will just have to adjust the uh, previous carrying amount. Okay, since the problem tells us that the fair value of the note on December 31, 2022 is 1,900,000, then that will be the carrying amount on December 31, 2022. So that would be uh, that would be bravo. The answer here will be bravo. The carrying amount of the note payable on December 31, 2022 is 1,900,000. Uh, you simply follow the fair value given for that problem. Okay, and then what amount should be reported as gain or loss from uh, change in fair value? You simply compare 2 million and 1,900,000. You will get 100,000. 8-23 on January 1, 2022. Davao Company borrowed 4 million on a 6% 4-year interest-bearing note. The net proceeds from the borrowing amounted to 3,677,600. Interest is payable annually every December 1. The entity elected the fair value option December 31, 2022. The bonds are quoted at 95. What amount should be reported as interest expense? Again, under the fair value option, interest expense is simply based on the face value of the note. Since the face value of the note is 4 million and the stated rate is 6%, uh, you multiply 6% with 4 million, you would get 240,000. And then what amount should be reported as a what amount should be reported as a gain or loss? You simply compare the carrying amount of the note, the previous carrying amount of the note, with its would be carrying amount, and its would be carrying amount will be based on the fair value. And the problem tells us that it is quoted at 95. What that means is that the fair value is 95% of its face value. Since its face value is 4 million, and then it is quoted at 95, that means 95%, multiply 4 million by 95%, and you would get 3,800,000. And then you compare that from the initial carrying amount of 3,677,600, you would get 122,400. The next question here, what is the carrying amount of the note payable? Again, the carrying amount would simply be its fair value. And as mentioned already, the fair value is 3,800,000.